right, so I think anyone who joins after will just jump right in. But Jackson, I want to hand it over to you to kick this off. So please, by all means.
Absolutely. Thank you, Miguel. Morning, everyone. My name is Jackson Lanehart. I work on strategic partnerships here at Turo. Excited to announce and kick this off, this partnership with Shared Economy Tax. We recognize for those of you that are new to hosting on Turo, this can be kind of a big question mark. And for those of you that are growing and listing more and more vehicles, it can become a really important piece of, how profitable your business is. And we recognize, and we obviously can't provide tax advice ourselves. That's really important to note. But really, the next best thing is partnering with someone that has the expertise to give you guys advice in this space. We're excited to partner here with Shared Economy Tax. They have an incredible team and really truly understand our business and what the tax implications can be. So with that, I'm excited to pass it over to Miguel and the Shared Economy Tax team.
Absolutely, and thanks for that introduction, Jackson. We're certainly excited to work with Turo this year. We focus so much of our own time building out how to do depreciation correctly, some of the things that we'll touch on. So actually, let's just use that to get started. First things first, I want to give you guys a sense of what we're going to cover on this call. We're calling it Tax 101, so just be clear, this isn't Tax 201, Tax 301. Every now and again, we get someone that wants to go into specific depreciation calc. That's something that we can kind of have one-on-one. Today, we just want to make sure that you have the right context. And we want to make sure that when we chat, or if you dig into tax, that we have a common language to tackle these things. So just to kick it off, we're going to share a little bit about who we are. We're going to then migrate into a broad overview on how taxes work. That should be pretty simple and straightforward for some, but it's also good to recap those things because it's going to flow into why we do things from an income or expense standpoint. And we'll touch on some mechanics of accounting, what you should care about that maybe you don't care about, or maybe reinforcing things you're already doing. And then lastly, we'll talk about strategy. So when we talk about strategy, right, what we're talking about is how do you make decisions that are going to be able to save you $3,000 in tax, $10,000 in tax, and even in certain situations, $30,000 in tax. Few disclaimers before we jump into things. I encourage you to read this throughout, but the basic point is this is general information. There are exceptions to every rule. That's part of what we do here is we'll dig in the code and see what the fact patterns are to see that everything applies. There are always exceptions, and those exceptions may apply to you. So be sure anything you take here that you take it into a more purposeful or meaningful discussion if you want to apply any of the strategies you hear here. So actually, before I jump into About Us, we do have a quick poll that we want to get a sense of who's on this call. So we're going to launch the poll here. And I'm going to give everybody about a minute to go ahead and let us know what type of entity you are. And this might seem out of the blue, but we want to understand, how many corporate owners, how many LLC partnerships we have on this call. And I can see people trailing in. And then we also want to understand, how many vehicles do you rent on Turo? And we'll kind of frame and touch on those things. And I'll just give it another 5 seconds here. Okay, we're getting a few more votes. Okay, it's coming in, it's coming in. I'll share the results here. It should be pretty interesting. So we've got a little bit of everything here. So I'll share results here. So it looks like the vast majority are going to fall into the sole proprietorship. So one of the questions we always tackle is, does it make sense to set up an entity? We'll touch on that. It's just good to know who's in the room here. It looks like a small amount of folks have LLCs, certainly important from a liability standpoint. Also, there's some tax benefits. And then we have an S corporation. So an S corporation to us is the ultimate signal of tax sophistication. If you set this up on your own, good for you, but usually it's a signal that there's an advisor involved giving advice on that. In terms of how many vehicles are on Turo, it looks like a good amount have multiple vehicles, and that's super important because the amount of strategies available to you will just increase with the number of assets. So I'm going to stop sharing that. Thank you, everyone, for participating in that quick survey. It's good for us to know who's on this call, but we'll actually just move on from there. So a little bit about us. We are a tax firm that's nationwide. We've been focusing on the sharing economy since 2014. Most of, if not all, the partners have Big Four experience. That means that we come from very big established firms and left because we wanted a better quality of life, but certainly wanted to work with businesses who were just as passionate about what they're doing. And we found that working in the growing field that has been the sharing economy. And just to give you some context, we're not new. We've been in the news. You can see that we've weighed in on some very heavy tax issues, including tax reform that took place in 2017. I should humbly admit that anything that I said to Congress, or I should say it this way, no recommendations I made that would impact the sharing economy ever made into the tax bill. And just a tidbit of information, I also happen to be a Turo host, so I know a little bit about kind of what happens on the back end. So a little context there that we do know some insides of it. So with that, let's jump into the basics on tax. We're going to breeze through here. I think, there's three real things that we want to make sure are understood. The first is that if you earn basically any amount of money, you're going to have to report it. And the biggest thing that we look at when we take on a new client is self-employment tax. So a lot of folks don't know, you earn $1,000, taxes get taken out automatically, and you don't worry about your tax bill. With any kind of sharing economy platform, the way the IRS looks at it is that this is self-employment income, and that's going to be subject to 15.3% taxes that don't get taken out, right? So for those that have already filed many years, you understand this, you understand estimated tax withholdings. We're just recirculating it here if in case this is your first year or second year where you've really got growth, you're going to have to start saving on the tax bill. The biggest thing from an accounting standpoint that we want everyone to know, if you forget everything else, is we don't care about your top line revenue. We don't really look at your top line earnings. I know you do, but from an accounting standpoint, we're going to look at the amount after deductions. And that's what the government's going to look at. That's what you're going to get taxed on. So super important to understand that. And then the last thing is what we will give the least amount of attention to, but I would highlight it here because it's still important, is that there are going to be local regulations that are going to be specific to your municipality. We have clients that do Turo in Hawaii. There's special rules there around business licenses. We have clients in all kinds of, cities across America where there's different rules around car sharing, and those are going to need some attention. We're just not going to cover it here. So make sure that you're taking a look at what the local implications are of the business. Entity overview. So I asked the group here, how many people are sole proprietorships? And oftentimes that's going to be the most one. Some people may have looked at it and said, I don't know. Well, I'll tell you that from a default, you're going to be a sole proprietor. That's going to be your default position. No LLC, no partners. The IRS says, okay, you're a sole proprietor. An LLC, we'll touch on here. Again, as I said a little earlier, the primary reason for setting up an LLC with most of our clients, and most of our clients are going to be Turo hosts with at least 3 vehicles, at least 2 vehicles, really. I think the vast majority are going to be the 3 to 8. The reason you're going to set up an LLC is for liability protection. And this is really a conversation that you want to have one-on-one because it's really going to follow your own personal risk appetite. That's a conversation that I'm happy to have with anyone who's interested, but the punchline is, does an LLC save you taxes? The short answer is going to be no. There are some financial reasons to set one up. For example, you get a different tax ID, you can borrow against the LLC. If the LLC goes belly up, that credit that you build there is separated from your personal. So in fact, if you have a credit card on your LLC, for those of you that follow metrics like credit card utilization, the credit card balance on your LLC does not get reported and therefore doesn't impact your personal support. So there are financial reasons to set up an LLC, but the number one take-home point I give clients, and they don't know this, is setting up an LLC on its own will not give you a tax savings, because a single member LLC is going to be taxed the same as a sole proprietor. So that covers a single member LLC. A partnership is going to be anytime you have someone else that shares in your business. So if you have a profit share with somebody, you're automatically going to be considered a partnership. That might be rolled into an LLC, and we usually recommend that it is. So, okay, tax benefits work a little differently for partnerships. I won't get into that too much here. And then to the right, we have our S corporations. S corporations are going to be tax saving structures, but only if you're at a certain level of income. So super important for folks that are just getting started or very comfortable kind of in the 20, 30K range. And S corporation is really going to start to make sense when you start having, again, what numbers do I care about? Net profit at the 50K level. And then lastly, C corporations. C corporations are unique beasts. Usually there are other structural reasons or capitalization reasons. For example, if you have investors who require a C corporation formation, or you want to have a separate entity altogether, C corporations are not going to be tax favorable because of double taxation. And what that means is that they are taxed, the profits you tax the corporate rate, and then when you pay yourself a dividend, that gets taxed as well. So there's two sets of taxes, which brings me to the point on the next slide, which is pass-through entities. So the number one point on entities that I want to make is that the three you're looking at here are all considered pass-through, meaning that any income that you receive within these is going to flow right into your personal tax return. So I always say it doesn't really matter what's going on in the business if you don't look at how it impacts you at a personal rate. So that said, if you are in a high income tax bracket, it might be valuable to have pass-through losses, right? Meaning maybe you've purchased a few vehicles, you've got more expenses than earnings. That's going to be a tax favorable strategy. On the flip side, if you have pass-through income and you already make a fair amount in W-2 earnings, just understand that that income, which is subject to self-employment tax, is going to sit on top of your top marginal tax rate. So pass-through is a very important concept when it comes to taxes. And I wanted to give a sense of what the tax form looks like. Again, this might look very familiar to many folks. The take-home point here is that this is a profit and loss statement, and it's just reported in a tax format. The things that I look at when we dig into these tax forms are going to be, number one, how do we represent the business, right? I think, car sharing is unique. You'll find that there is no code that ties directly to car sharing. So you want to look at, how you represent that. And we typically go with the other business. And there's reasons why for that, which I'll touch on. And then the other thing that we look at is we're very keen on looking at the dollar amounts in these categories. These are going to be the top ones. And the way that the IRS looks at expenses within a business is they are going to compare comparables in the industry code, right? So industry code is important because you automatically get put in a bucket where you're statistically looked at within that category. And then the percentage of expenses to sales becomes important. So as an example, if you have a, I'm going to say a service business with a lot of vehicles and machinery, say it's 50, 60% of sales, that's going to raise red flags. Professional service business, you would expect to be very heavy on payroll and contract labor. So I use that contra example to kind of flip it. Within a Turo business, I would expect car expenses to be significant, vehicles to be significant, and these are the things we look at. And sometimes we also talk about overhead. Can I write off travel? Can I write off meals? We'll touch on that. The answer is yes, but the take-home point here is you want to be conscious of what that is as a percentage of sales, because you would not expect someone who runs a car sharing business to basically have like 50% of their earnings go to meals and entertainment. That just wouldn't make sense. There's not enough whining and dining. Some, that's okay. Again, the way we assess risk is going to be on a percentage of sales basis. So be mindful of that when you construct those out. I also wanted to show what the other type of corporate entity returns look like, or partnership entity returns look like. The reason this is important is because whereas the Schedule C that we showed before attaches to your 1040, if you have a partnership, understand that you're going to have to file 2 tax returns. Form 1065 gets filed with the partnership. So, if you and a buddy are going to split the business, just understand first you have to file a separate return, which is going to explain the P&L. And then from this, you're going to receive a K1 that is going to attach to your personal. So just like before we had the Schedule C that attached to the personal, that one's more direct, the sole proprietorship or the single member LLC. It's going to be very straightforward. We'll just go back to it, right? It's going to be very straightforward. This is just going to be a page in your 1040. However, if you file a partnership or an S Corp on the next slide, what's going to happen is you're going to have to file a separate tax return first, a corporate return, and then that's going to provide what's called a K1 that attaches to your personal. But the point is, the P&L for a partnership or S corporation is going to live on that separate return. All that will show up on that K1 to your personal is going to be what? Your net profit and some other items. So we've talked a lot about passive and active businesses. This is something that we always chat about with our host, because it's important to understand that when you have a passive business, meaning you don't do anything, there's no self-employment tax assessed. So there's more tax favorable treatment to having a passive business. That gets filed on a Schedule E, much like a long-term property would. There is a case for saying that your Turo business is passive. Just understand that there are explicit tests that are going to dictate which form you can use. You can put numbers on whichever form you like, but just understand if it's ever reviewed, that fact pattern is going to get questioned. So it's super important to understand that the crucial difference from where we sit is going to be, how active are you in managing the business? Do you handle the messaging? Do you show up to exchange, to hand over the keys, right? Those would all fall under what I would say is active. Passive would be, hey, I pay manager to basically run the whole business for me, and I just collect a check at the end of each month. Sounds nice. We rarely see it. So most of our filers are going to end up on that Schedule C active. And we've talked a lot about P&L, and clients usually ask, well, okay, how do I do it, Miguel, right? It's June of the year, or, even if we're in February and we're looking at 2020 and we're not looking at 2019, how do I start getting good about recording my expenses? And what I always say is everyone should have a summary in Excel, if not in QuickBooks or Xero, which is my preference. And it should look like the tax form, right? So this will look a lot like the P&L that you've seen before. And then we want to make sure that we're including the main categories that would be, within the business. So you can see auto expenses, cleaning, depreciation of assets. These are just very common expenses that we would expect. Again, overhead is okay, right? Overhead is completely allowable. And what's key, though, is to understand the percentage of sales. So if you look at this business, actually, this is what I would call a first-year business. You've got 51,000 of operating expenses on sales of 5,000, and that commission's wrong, right? That should be updated. But the point is that you would basically work this out to your business. Your commission rate would be the 20% or 30% that you pay, right? So then you've got your gross profit. And then from that, you deduct your overhead. So again, is it okay to have supplies at that rate? It's going to depend on your specific situation. But what we typically say is, look, year 1, year 2 of the business, if you've got a giant loss, that's okay. However, and back to the point on the pass-through, right? Somebody with the $46,000 loss is going to get a huge chunk of taxes back if they've got other W-2, because of the pass-through nature of the business. So really important to get clear on, what does the P&L look like? What is the percentage to sales of every category, and is it okay? That's a conversation that you want to have with an advisor. And then once I have my income, right, going back to my point on pass through, how does that pass through to my personal return, and what impact does that have on me? So let's talk a little bit about income and expenses. I want to get into very specific examples here just so you get a flavor of how we think through things. Income, I always say, is the easiest part, right? Income you can pull very easily. Some of you will get a 1099K, although it will be rare, right? You've got to have 20,000 revenues. Okay, that's not that hard to hit. And 200 transactions. So that's usually somebody with multiple vehicles where they're renting multiple times per week. If you get that, then you've got a 1099K. And I always say, look, if you get one of these, forget the number that you have in your earnings profile. Forget the number that hit your bank account. What you want to reconcile to is what the 1099K has, because the IRS will have this this number, right? So if it's 40,000 here, but you're like, wait a minute, only 30,000 hit my bank, I'm going to say report on the 40,000, because the 40,000 is what the IRS is going to see. And in fact, if you file on less than that, you will get what we call a nastygram from the IRS, or a letter that says, we received a 1090K for 40,000. We don't believe you reported on it. So again, report the gross amount. You're going to see box 1A says gross amount, and then deduct on your expenses the commissions and fees that got subtracted. Other ways that I've seen information come from Turo, there's a few ways to get it, right? If you don't get the K, I would say export your transactions. You'll get a CSV like this, and then you want to add up your earnings. There's also, and I commend Turo for it, a email that you get at the end of the year, right, with your gross transaction amount. And again, like I said, you want to report on your gross transaction amount. I think in this email, if you scroll down, you'll actually see that the fees are included, right? So include the gross transaction amount as box 1A as your earnings, and then subtract out any commissions paid. Income's the easy stuff. What we also want to talk about are all the overhead that might apply. I'm not going to go through each of these, but if you get the recording, or if you have the ability to screenshot this, I would, because you really want to go through line by line everything that might be applicable. The number one thing that I encourage people who are conservative with their numbers to do is look at doing some travel. I mean, I'll just tell you from experience, I just got back with my family from Maui, and we rented an awesome Jeep Wrangler on Turo. It's called Orange Crush, and it was amazing, but it was also deductible. Why? Because I happen to be in a business where it's important for me to understand what other hosts are doing. And therefore, I consider that a deduction within my business. So I also stayed at an Airbnb, and I happen to have a tax practice dedicated to that. So that's also research. So I think it's important to understand that accountants are actually okay with creativity around increasing deductions. It just has to be done within a measured way. So going back to my big thing, if I was in a room right now, I'd say, what's the biggest thing when we look at each category of expense? And I would want you to say, to look at it as a percentage of sales. And I know I'm repeating myself and that's getting boring, but that's how you're going to remember it. So each of these are important as it relates to your percentage of sales. So going back to anything that we talk about, right? Travel. Should travel be 20% of revenues? If I made $5,000, should I have $20,000 of travel? No, right? If I made $5,000, could 20% of that be travel? Maybe, right? That's kind of where we get into nuance. So no hard and fast rules, but definitely look at what those numbers say, because the IRS computer, yes, there is an IRS computer, is gauging risk. Every tax return gets a score based on how different and special you are. So number one thing when it comes to expenses, be creative, look at your list of what's going on, look at credit card interest, look at legal and professional fees. If you hire an accountant, write that off within the business, but be smart about it. Look at how it looks overall, and speak with someone that can kind of walk you through, hey, this looks very unique. Because the number one thing you don't want to be, I don't care what we were told about being special and unique. Sure, that all applies to the market, but when it comes to taxes, you want to be vanilla, you want to be bland. And that's something that we look at as we look through a P&L. In terms of how you record things, we always go over this with clients. I say at minimum, write everything down. And this is just an example of one way to do it in Excel. There's 4 things that matter from a tax perspective: the date, the vendor, the business purpose, and the amount. The truth is, all of these are going to be on your bank statement. The only thing you'd need to apply is business purpose. So if you have a dedicated business account, you have a huge advantage because you can connect that bank account to something like Wave Apps, which is completely free. And if you have nothing, I recommend you go set up a business account right now and connect to Wave Apps. Or you can connect it to QuickBooks or Xero, which are just going to be a higher level of sophistication. We use those, but at very minimum, if you have a dedicated business account, all you need to do is assign a business purpose, and boom, you're audit proof. That's what the IRS has required. So we've been in audits where the client didn't have any kind of accounting software, and all they said is, let me see the bank statements. So we printed out pages and pages and pages of bank statements, highlighted what was for example, supplies in like pink, and then we added up the totals on the bottom, and like meals we did in green, and that passed muster. You know, it has to tie back to the bank account. It has to have those 4 things. And look, if you don't have an accounting system, do it in Excel, right? Take a screenshot of this, go out and do it, add it all up. I will say though that there are some risks around doing it this way, even though this will satisfy an audit, is that technically the IRS can disallow any mixed personal and business accounts. So I can say, you know what, it looks like you just kind of randomly picked things, right? Like, was AutoZone really business versus personal? We don't think you have a system, so we're going to disallow it. So the IRS is allowed to disallow expenses that happen in a mixed account. So be aware of that. It's not very common that the IRS will say, hey, absolutely, we're not going to allow this deduction, but they might. So for that reason, I think it's very important that the business account gets set up, even if you're a sole prop, set up a separate DBA and get into some accounting system. Business expenses, I think, so we covered a vast majority of them. I think business expenses get complicated when you have to do allocations. And what I mean by that is if you go look at your cell phone, right? You take the position, hey, it's 50% business, 50% personal. Does that hit the business account? Does it hit the personal account? I'll tell you that year one, the process is figuring out what's reasonable and coming up with a percentage that is fair for your business. So I'll give you an example. If you have a vehicle that you just started renting out in November and it was your personal for most of the year, and you drove the average amount of miles, you drove, you know, I'm in LA, so, you know, I'd say it's 15,000 miles you drove, and you've got something like 800 miles on trips. Your business percentage, it'd be hard to argue that it was 50%. So how can you take 50% and apply it to your cell phone? Those are the kinds of conversation, that's the kind of nuance that is difficult. And it gets even harder when you start looking at vehicle depreciation, because you do have to take a business percentage. And there's different rules when your business vehicle is less than 50% than when it's above 50%. So allocating percentages is something that we want you thinking about, but maybe something that you lean on an accountant for. So that covered our income and deductions overview. Now I want to talk about a few ways that we see incredible savings for clients. And before I do that, I want to highlight that when it comes to our tax consulting business, that is completely distinct from our tax preparation business. That's the way that taxes work. Today, if most of you on the call are looking to hear about 2019, that chapter is closed. That ink has dried. My ability to help you, the amount of tools that I have in my tool shed to cut your tax bill are limited. However, it's 2020 and the economy's roaring, business is booming, things are going well. What I can do today in February to decrease your tax bill come next year, is significant. So when we talk about projections and strategy, just understand, you start licking your chops on, hey, I'm going to save $10,000. Just understand it's likely going to be for 2020, not for 2019. And again, going back to kind of how we do things, and this one is the one I wanted to share, right? So you've got your projection here, and this is us saying, hey, look, this is what we think the year is going to shake out to. Let's start putting numbers in here, right? So we've got 90,000 in gross receipts. Turo is going to charge a commission on that, right? So your gross profit is, let's just say it's 67, and then you go through your list of expenses, and at the end of the day, you say, hey, I have operating income of about 23,000. Let's just say it's in the 20s. What I'm able to tell you at that point is, look, if you do nothing else, and the year does in fact continue this way, you will have a $3,500 tax bill, good or bad. I have clients that say that seems reasonable. I saved 4,000, so I'm getting money back. I have clients that say, oh my gosh, where did that cash go? I don't have that money in my bank. The point is that, again, talking about 2019 is going to be retroactive, but if you project out what the year might be like, we can really impact this number by doing a few things. And one of the things I always talk about is accelerating depreciation. So depreciation tables are complicated. You can take a screenshot of this and look at it. We've got a few articles on depreciation you can look at, but I'm just going to breeze over it real fast, right? Based on the asset value, based on the business percentage, it's going to impact what you can deduct annually, right? So in many cases, the straight line way to depreciate is going to be 20%, right? So you divide the asset value by 5. That said, there are limits to what you can depreciate or what you can annually deduct in a business, but there are also acceleration techniques, which, for example, if you have a vehicle that weighs over 6,000 pounds, and there's a specific number you want to look at, you can accelerate depreciation. So in this case, I first show depreciation. It's about $20,000 without accelerated depreciation, right? So back to our example, if we had about 20,000 depreciation, you owe about 3,500 bucks, right? Because there's about 20K left in profit. Well, let's accelerate that depreciation. And what we're basically doing is, if you look at the Toyota Tundra, I know there's a typo there, just so you guys know I'm human, but the numbers are right. The special is going to be an extra $18,000 in depreciation. So just like that, we went from 20 up to about 40. So what would happen to that $3,500 tax bill? It would be zeroed out, completely wiped out. And in fact, if you get into a small loss, you're going to be able to claw back some of the withholding on maybe your W-2 income. So just like that, in these two slides, right, we saved about $3,500 just in self-employment taxes. Don't even cover the 20 or 25% of federal income taxes that would apply to that. So just with accelerating depreciation, you're going to be able to save around $5,000 in federal taxes alone. Very important to note. Also important to note is that it depends on when the asset was placed into service and when it was purchased. So if you say, hey, wait a minute, can I get special depreciation on a car I bought 3 years ago or I bought used? The answer is going to be maybe. The real kind of take-home winners are going to be new vehicles that are purchased, not leased, right? And again, it doesn't have to be a full cash purchase. A lot of times clients say, well, I financed it. Can I still get this huge deduction? The answer is yes. And that's why we've seen clients come in our doors and say, hey, I want the Model X Tesla. What does this look like for me if I put it on Turo? And sometimes we're able to generate some significant savings because it's a heavy vehicle, because it's new, and it doesn't matter that it's financed, right? So in many situations, you've got a case where your cash outlay is low because you're financing it. Finance it over 5 years, right? On a $115,000 vehicle, your cash outlay is going to be low, but your tax deduction, if you take 50% of that purchase price, you're going to have a $50,000 loss that's going to chip away at whatever earnings you generate. So again, going back to everything I'm saying, I'm breezing through this stuff. The way we do it is we typically do a tax projection, not just on the business, but on your personal. And we look at everything from when you bought the vehicle to how many miles you put on it to what type of make model it is, right? And that's how we get into some of these details. But again, I want you guys to have enough context to understand that there are available strategies for you, and that if you're not even thinking about Section 179, or you're not thinking about accelerated depreciation or bonus depreciation, you should really think about it, because these are savings that are going to be available to folks that have, even one vehicle on Turo. So again, look at it. It's super important. And by the way, you don't want to get it wrong on the tax form, because actually this table is actually going to show up on a depreciation form. So even if you say, I don't want to get into this, I don't do the strategy, well, news for you, you have to do these depreciation tables anyway. Oftentimes tax software will kind of get it right, but you'd be surprised. We've actually found some that have been improved, shall we say. The other thing I tell clients, and if you're in year 2, 3 of the business and you're growing every year, which our clients tend to do, is that even if you're not feeling the pain now, you might later. And what we want to get our community thinking about is, what are the growing pains that come with growth? I mean, I think right now, if you're growing, just go do that, right? Go run your business. But think about what the tax impact might be, because those are going to be checks that you actually have to write. So in this, we usually take the scenario of, what if you're going to grow, 4x, 5x, figured out your business model, what's that going to do for your tax bill? And oftentimes the self-employment tax is the one that's going to be punitive. And what we typically look at is, okay, well, maybe it makes sense to roll into an S Corp. I said before, if you're in the 50K range, you about get to the break even. So what I wanted to show is how to create a $15,000 deduction. Sorry, a $15,000 tax savings. It's not a deduction. It is literally a swing in the check you are going to write the government. And what we have here in column, in the left column, is what happens if you're just a single member LLC, right? On operating profit of 216, your tax bill, as we show here, is going to be 72 total, right? Again, there's some assumptions in here. You might say, oh my gosh, it's super high. It's effectively a 33% tax rate. So if anyone, remembers when they got that first check, when they thought they were going to get $100 and they got 60, that is where this percentage comes from. But let's look at the S corporation. The S corporation requires that you issue some level of payroll. So what this model assumes is that $60,000 has been issued in salaried payroll. That's W-2. That isn't you transferring money from one bank to another. It's actually processing tax payroll. And that's going to deduct your profit, right? So from 216, 250, 2.25 about, it'll go down to about 1.5 plus the 60, right? The total income stays the same. But because of the way it's structured, what's really going on is that the profits from the S Corp, that 156, are not subject to self-employment tax. I want to say that again, because that's the punchline. Operating profits from an S Corp are not subject to self-employment tax. And that's why whoever filled out this poll at the beginning is in an S Corp, right? They're doing it for the tax savings. They've been advised, they figured this out. Maybe they have businesses already, and they figured out, hey, look, there's a big tax swing. Who would want to write a check to the IRS for $15,000? If you want to pay more taxes, go ahead. Take out a checkbook, write it to the Department of Treasury, and go ahead and write $15,000. No, that's crazy, right? You'd never do that. So what I always say is think about it that way. Think about tax strategies in the sense that you are leaving money on the table. You are literally taking out a check and sending it, right? I don't want you to think, oh, well, it's just easier to do something. No, it's not. There's literally tax dollars that we want to make sure stay with the business. You can grow your business far better than anyone else. So the more cash you have in your business, the better. So those are just two examples. Again, we just covered what accelerating depreciation can do for you, as well as an S Corp election. Again, understand that these are nuanced things. The numbers are going to change based on where you're at, but we want you directionally to start thinking about some of the tax strategies that can get you into a better tax position. Questions. So there is a chat feature. We have Sean, who's with our firm here, and his email is actually listed there. If you have any questions, you can email him. But I want to give maybe 5-10 minutes, unless everyone's just sick of tax, to go ahead and chat questions. Sean will look at them and maybe answer some. So go ahead. This is your time. We'll try and get into questions, but if not, our numbers are listed here. You can call our main line, and you can always connect with us if you go to our Get Started page. So as soon as you hit Get Started, someone will reach out to you within 24 to 48 hours. It never hurts to get a second opinion or to speak with someone, that will be Sean. So again, I'm just going to give about 1-2 minutes of silence here. If I don't get any questions, we can happily wrap up. So I am seeing some questions here. So somebody asked, what's the app name again? So the app is Wave Apps. It's a completely free online solution to tracking, connecting your bank account and then tracking those expenses. It's going to be waveapps.com. And in fact, what I will do is I will message here the URL to that. And then I got a question here from D. Rich. It says, I've heard that business use of vehicles can be calculated by days listed and days owned. Is that true? Absolutely, that's true. So when it comes to allocating between business and personal, you'll remember I was talking about it's nuanced. And what that means is that the allocation factor needs to be reasonable. Allocation factors can be based on time, they can be based on space, right? That's why you'll see square footage involved sometimes when it's a rental type business. For vehicles, the easy one is going to be mileage, right? So I think the point is, be prepared to understand the sensitivity between the two. So like if miles is very, very small, but hey, this car sat on the lot and I didn't touch it and it was on Turo, that you want to look at the difference between the percentages, but I wouldn't expect them to be too different, right? So if you've made them available, it's important that you're not using it. Otherwise, it's going to be personal usage. Just to say, hey, I drove my car to work every day, but it was on Turo, that's not going to cut it, right? So the disparity between the two are important. Sensitivity analysis between the two are important. But just as a binary question, can you use days outstanding, days available, days rented to total to 365 or whatever it is? The answer is yes. So I also got a question. Does it make sense to lease a car to deduct the taxes? I think it's going to depend on a number of things, right? So if you're deciding between leasing a truck that you're going to put on Turo, right? And that truck is going to satisfy that weight requirement. Well, you're going to be giving up a huge deduction because that section 179 says you can take half of the purchase price times the business percentage, and you can deduct that, right? So when you look at a lease that's going to be $400 or $500 a month, it's going to be about $6,000 a year, and that's your deduction, right? And it's cheaper, right, from a cash perspective to buy it. Maybe it's like $350 a month, but you have a $40,000 truck. Well, what you're going to get is you're going to get a $20,000 deduction on the purchase versus the $6,000 on the lease. That's where I'd kick it back over to you and say, oh, what do you think, right? So I think there's a conversation there, and it's going to depend on the type of vehicle. But the nice thing about leases is that if it's 100% in the business, and I sometimes talk about, hey, I take the position that this vehicle is 100% business because I have another vehicle, right? That's, again, getting maybe more aggressive, but again, nuanced. Well, with a lease, you can deduct all your payments to the business, and sometimes that's just easier from an accounting standpoint, right? I don't have to calculate depreciation. I know that I spent $500 a month, so it's going to be a $6,000 deduction at the end of the year. I'm happy. Everyone's happy. But again, it's going to depend. I got another question here. This is kind of a long one, so I'm just going to through it. Oh, this is actually a really good question. So Ian asked, I had one car. I took standard mileage in 2019 for 2020. Can I take depreciation? This is a really good question, and it brings a point that really I should have covered, that mileage versus depreciation is a very important decision that impacts the life of the vehicle. It's so easy to calculate miles, right? Which is why we don't touch on it. So 1,000 miles times 58 cents. That math is really easy, but just understand that if you should look at depreciation also, because you're deciding between the two. Whatever you do in year one of the business, for that vehicle has to continue through the life of that asset. So if you choose mileage in year one, unless you amend that return, you're married to mileage, right? Even more commitment than marriage these days, right? You're committed to that. You can't change. So really important question, and that's why it's so important to understand depreciation. Sometimes depreciation isn't a very good deduction because you're dividing it by 5. So on used vehicles, where you buy a vehicle for $5,000, you divide that by 5. That's $1,000 deduction a year, where it only takes 500 miles to beat that, right? So again, you want to look at both of those, but really, really good question. I got another question. I'm just going to paraphrase it here just to give everyone kind of a sense of what we're thinking about. So I have an S corp for another business. That business is going to stop. Can I use that S corp for my new business? The answer is yes. I mean, but just be mindful that with an S corporation, you've got something called basis, which tracks year to year to year, right? So any basis you had in that S corp is going to continue throughout the life of that S corp. So again, nuanced discussion. Sometimes it makes sense to hit the reset clock. But if you're just saying, hey, can I use this business? Can I use this bank account? The answer is yes. Your tax return is just going to be a little messy. Can we see the slide before the one titled Have a Comprehensive List? So what I'll do is I'll circulate the webinar presentation as well as the PDF materials to everyone here. So you have that, but I won't go back to that right now. I'm going to stop there. Sean, I don't know if at this point we can start maybe just responding in the group chat. There are some good questions here. Some are maybe a little too specific, but let's kind of take a look at this one here. Does the value of depreciation card include loan interest and tax paid at the time of purchase? Does that need to be separated to their appropriate expense category? So the question is, hey, I bought a vehicle, right? The purchase price is, well, let's just say it's $10,000, but I paid these registration costs, I paid taxes, I pay interest. Do I add that to the basis of the vehicle and depreciate everything, or do I break it out? And I would go with break it out, right? Again, this is just general, but interest would definitely be separated out. That would be on the interest line for the deduction. The purchase price is really going to be the amount of the vehicle, and then taxes I would also expense because, and of course this, right? The benefit is that you get a 100% deduction in year one, and you don't have to spread that out over 5 years. And then Sasha, you asked a pretty technical question. I'd encourage you to reach out to Sean here on his email with that if you want to talk through it. Just understand we can't advise you without an engagement letter in place that explains our liability. It explains what tax we're liable for. So I can't get too technical in this. I'm going to actually wrap it up there. So what I want, because I want to encourage everybody to make sure that you get a sense of the materials discovered. We'll send this out. We have articles that we cover on depreciation to give more context around how we work. You also have our contact information here if it makes sense to continue the conversation. I'm going to wrap it up there. It's been such a pleasure working with you. Jackson, always a pleasure. Love what you guys are doing over there. And if we can be of any resource, either to the hosts on the call, or if you just have general questions, we'd be happy to connect there. Look forward to connecting. It's been an absolute pleasure, and we'll chat soon.